Welcome back to Smart Dollar Mindset, the channel dedicated to helping you achieve financial freedom through smart money habits and investing. If you're watching this, chances are you've heard that investing is one of the most powerful ways to build wealth, but you're not sure where to start. Maybe you're overwhelmed by the jargon. Maybe you're scared of losing money. Or maybe you've just been putting it off, waiting for the right time to invest. Well, today is that time. Because in this video, we're breaking down everything you need to know about investing for beginners, step by step, in plain language, with real-life examples. By the end, you'll not only understand the basics of investing, but you'll also feel confident enough to take action and start building wealth today. So let's dive in. Why investing matters. Before we get tactical, let's answer a big question: why invest at all? The answer is simple: because saving money isn't enough. If you put $10,000 under your mattress, in 20 years it's still $10,000. But, thanks to inflation, that money will buy a lot less than it does today. If you put that same $10,000 into an investment earning 8% per year, in 20 years it grows to almost $46,000. That's the power of compounding, your money making more money for you, even while you sleep. Investing is how average people become financially independent. It's not about gambling or getting rich quick. It's about time, patience, and consistency. Step 1. Define your goals. Investing without goals is like driving without a destination. You need to know what you're aiming for. Ask yourself, am I investing for retirement? Am I saving for a house down payment? Am I building wealth for long-term freedom? Your goals will determine your strategy. For example, short-term goals, like buying a car in 3 years, should be in safer investments. Long-term goals, like retirement in 30 years, can take on more risk for higher returns. Step 2. Understand risk and reward. Here's the golden rule of investing: higher returns usually mean higher risk. Cash in a savings account? Very low risk, very low return. Stocks? Higher risk, higher potential return. Bonds? Somewhere in the middle. But here's the secret: over time, the risk of not investing is greater than the risk of investing. Because inflation guarantees that if you do nothing, you lose. Example: if inflation averages 3% per year, in 20 years, $100,000 will only have the buying power of about $55,000. Investing protects you from that erosion. Step 3. Learn the main investment types. As a beginner, you don't need to know every complex financial product out there. Start with the basics: stocks, ownership in a company. High risk, high reward. Bonds, loans to governments or companies. Lower risk, steady returns. Mutual funds, bundles of stocks and/or bonds managed by professionals. ETFs, exchange-traded funds, similar to mutual funds but traded like stocks. Index funds, funds that track the overall market, like the S&P 500. For beginners, index funds and ETFs are often the best place to start because they're low-cost, diversified, and historically strong performers. Step 4. Know where to invest. You need an account to start investing. For most beginners, that means a brokerage account, Fidelity, Vanguard, Charles Schwab, Robinhood, etc. A retirement account like a 401k or IRA. Start with employer-sponsored retirement plans if available, especially if they offer matching contributions. That's free money. If you don't have access to one, open your own IRA or brokerage account and start small. Step 5. Create an investment strategy. This is where many beginners get stuck. They ask, what should I buy? Here's a simple beginner-friendly strategy: 80% in a total stock market index fund or S&P 500 index fund. 20% in a bond index fund for stability. If you're younger and have decades ahead, you can go more aggressive: 90% stocks, 10% bonds. If you're closer to retirement, go more conservative. The key is diversification. Don't put all your eggs in one basket. Step 6. Automate your investing. Wealth is built through consistency, not one-time actions. Set up automatic contributions from your paycheck or bank account. Even $100 a month grows dramatically over time. Example: $100 per month invested at 8% grows to about $150,000 in 40 years. $500 per month becomes over $750,000. The earlier you start, the more powerful compounding becomes. Step 7. Avoid common mistakes. Most beginners lose money because they make emotional decisions. Here are the mistakes to avoid. Trying to time the market. No one knows the perfect time to buy or sell. Chasing hot stocks. By the time you hear about it, it's usually too late. Panicking during downturns. The market will fall sometimes, but it always recovers over the long term. Remember, investing is not about what happens today, it's about what happens over decades. Step 8. Learn from real-life examples. Example 1. Sarah started investing $200 a month at age 25. By age 65, she had over $600,000, even though she never invested more than $200 per month. Example 2. John waited until age 40 to start investing $500 per month. By 65, he had $450,000, less than Sarah, even though he invested more money. The difference? Sarah had time on her side. That's why the best time to start is now. Step 9. Build an investor mindset. Investing isn't just about money, it's about mindset. You have to shift from thinking short-term to thinking long-term. Ask yourself, do I want quick wins, or do I want lasting wealth? Am I willing to be patient while my investments grow? Am I committed to staying the course even during tough times? Your mindset determines your results. Step 10. Take action. At this point, you know the basics. But knowledge without action is useless. So here's your action plan. Open a brokerage or retirement account. Fund it with whatever you can afford, even $50. Buy a simple index fund or ETF. Set up automatic monthly contributions. Leave it alone and let it grow. That's it. You don't need to be a financial genius. You just need to start. The freedom factor. Every decision you make today shapes that future, turning your dreams into reality. The small sacrifices and disciplined choices you embrace will open doors you never knew existed. It's about more than just accumulating wealth. It's about the experiences and opportunities that come with financial freedom. Picture yourself exploring new places, bonding with loved ones, and truly savoring life. The path to this life begins with a single investment, planting seeds that will flourish over time. In the end, your journey toward financial independence will not only change your life but also the lives of those around you, creating a legacy of wisdom and opportunity. Embrace the process, take bold steps, and watch your dreams unfold. Your future awaits, vibrant and limitless. Final thoughts. Here's the truth. Investing can feel intimidating at first. The financial world is full of jargon, noise, and people trying to sell you things you don't need. But it doesn't have to be complicated. At its core, investing is simple. Save consistently. Invest in diversified, low-cost funds. Stay patient. Don't panic. And most importantly, start as early as you can. The earlier you start, the more time you give your money to grow. But no matter your age, the best time to start is today. We've covered everything from defining your goals to choosing your first investment. You now know enough to take action. You don't need to wait for the perfect time. You don't need to have thousands of dollars saved. You just need to start. Remember, investing isn't just about money, it's about freedom. It's about creating choices for yourself and your family. It's about building a future where you control your life, not your bills. So take the first step. Open that account. Make that first investment. And then keep going. Consistency beats perfection every time. If this video helped you, subscribe to Smart Dollar Mindset. We're here to give you the knowledge, strategies, and encouragement to achieve financial freedom through smart money habits and investing. Your future self will thank you.